Hello and greetings to everybody. In this video clipping, I will be briefing about the chapter Capital Structure Planning, which comes in financial management. In my earlier video clippings, I have spoken about weighted average cost of capital. I've spoken about operating leverage, financial leverage, combined leverage, and I have also given a clipping in which I've spoken about capital budgeting. Students, in financial management, there are topics which are interrelated. So, weighted average cost of capital, sources of finance, capital structural planning are all linked with each other. So, in this small clipping, let us look at what is capital structure planning, and we will look at one method, that is how to design the capital structure considering highest or maximum possible earnings per share EPS. Meanwhile, for students who want and for students who are interested to learn financial management with me as a curriculum, as an online coaching, please contact me. My number is 9967029869. Whichever university you are studying in, whichever college you are studying in, we will amend the syllabus, we will amend the learning as per your requirement, as per the syllabus designed by your university, by your curriculum, and we will take the coaching ahead. Let us now look at what is capital structure. Well, this is an example in which there is a company which has already got 5,000 equity shares of 100 rupees each, which totally amounts to 5 lakh rupees of equity capital. This company, which has already got 5 lakh rupees of equity capital with 5,000 equity shares, now wants to raise another 5 lakh rupees capital. And to raise additional 5 lakh rupees capital, this company has got four options to select from. The first option is entire 5 lakhs it is going to raise through equity. Since nothing is mentioned here, we assume that this additional equity will also be raised at the rate of rupees 100 per share. So option A is full 5 lakhs we will raise through new equity capital. Option B is entire 5 lakhs you will raise through loans, through 10% debentures or 10% debt. So you will raise the entire 10 lakh by loan on which you will pay 10% interest. The third option is to raise 5 lakhs. 2.5 lakhs we will borrow, we will take loan on which we will pay 8% interest, and the balance 2.5 lakhs we will have to raise through preference capital on which we will pay 8% dividend. So 2.5 of loan plus 2.5 of preference capital, total amounts to 5 lakh rupees capital. And the last option D available to the company is wherein entire 5 lakhs it will raise through preference capital only, on which it will pay a 10% preference dividend. So now the company has to select the best option considering the option which will give the highest earnings per share, that is EPS. We have spoken about weighted average cost of capital in my previous videos, and considering WSCC, always we will have to raise funds in such a way that the overall cost of capital for the company is minimum as possible. There is a chapter called as Sources of Finance in Financial Management, in which we will learn the merits and demerits of each source of fund. We will learn about advantages, disadvantages of equity, of preference capital, of debenture, of each source of fund. So there are different aspects to be considered when we have to decide on the right proportion of loan funds and own funds. One is the weighted average cost of capital. Here we speak about the earnings per share. Now, in this example, I have assumed a tax of 30%, and another assumption being made is the earnings before interest and tax, EBIT, post expansion will be rupees 1,50,000 rupees. Post expansion in the sense, after raising the additional capital of 5 lakhs, after the additional investment is being made, the earnings before interest and tax will be 1,50,000 rupees. So here we go to solve the problem. We have got four options A, B, C and D. So when we make an income statement, sales minus variable cost gives us contribution. Contribution minus fixed cost gives us EBIT. EBIT minus interest is EBT. On that you pay tax, you get earnings after tax. Once you get earnings after tax, we first pay the preference dividend. After paying the preference dividend, the final earnings after tax after paying preference dividend is the EAT, which is left for equity shareholders. This is for equity shareholders. So this earnings which is left for the equity shareholders, we will divide with the number of shares to find earnings per share EPS. First, let us look at the income statement and apply it for each A, B, C and D. Option A is wherein we raise the entire 5 lakh through equity. So if you are raising the entire 5 lakhs through equity, there is no interest to be paid. Interest is to be paid only on loan funds. Since we are not borrowing, in first case the interest is nil. So EBIT is 1,50,000 rupees, no interest to be paid. So earnings before tax is also 1,50,000 rupees. On this 1,50,000, we will pay a 30% tax. 30% of 1,50,000 will work to 45,000 rupees. So once 45,000 rupees of tax is paid, earnings after tax is 1,05,000. Now in option A, we are raising entire 5 lakh through equity. Since we are raising through equity, there is no preference dividend to be paid. Hence, preference dividend is also nil. Therefore, what is left for the equity shareholders is rupees 1,05,000. This 1,05,000 rupees will be divided amongst the equity shareholders. As it is, currently the company is having 5,000 shares of 100 rupees each. Now, another 5 lakh rupee raised, another 5 lakh rupees to be raised. Since nothing is given, this 5 lakh rupees will also be raised at the rate of 100 rupees each. So this is 5,000 existing number of shares plus another new 5,000 shares. So total number of shares will be now 10,000. Wherein 5,000 is existing, 5,000 is new. This 5,000 is new because total 5 lakh rupees divided by 100 rupees each. So 5 lakh rupees divided by 100 will give us 5,000. So existing 5,000 plus new 5,000 shares will give us total 10,000 shares. So when I divide 1,05,000 rupees earnings amongst 10,000 equity shares, I get the earnings per share as rupees 10.5. Now let us look at option B, in which we will be raising the entire 5 lakh not through equity but through loans, but through debenture, on which we will pay a 10% interest. So 5 lakh mein 10% matlab it will amount to rupees 50,000. So EBIT is 1,50,000, on which we now pay an interest of 50,000 rupees. So when you pay an interest of 50,000 rupees, EBT is now 1 lakh. On 1 lakh, we will pay 30% tax, which is 30,000. So earnings after tax is 70,000. Since we are borrowing, since it is debenture and there is no preference capital involved, preference dividend is again nil over here. So what is the amount available for equity shareholders? It is 70,000. Now this 70,000 you will divide with number of shares. The number of shares will be currently 5,000. In option B, there are no new shares issued. It's only debentures. So when there are no new shares issued, the number of shares will be same existing, that is 5,000. So this 70,000 I'll divide by 5, which will give us 14 rupees of earnings per share. Now we see that instead of borrowing through equity, instead of raising funds through equity, when we borrow it, we pay an interest of 50,000 rupees, but the earning per share is increasing. So here, when I compare option A and B, raising funds through equity versus borrowing funds, we find that borrowing funds are better because the earnings per share is increasing to rupees 14. Now let's look at option C. Option C says to borrow rupees 5 lakhs, we will have 2.5 lakh of loan and 2.5 lakhs of preference capital. On loan we will pay 8% interest and on preference capital we will pay 8% dividend. Now, EBIT is 1.5 lakhs. 2.5 is the loan on which you pay 8%. So 8% of 2.5 lakh is 20,000. So interest is 20. So after deducting interest, your EBT is 1 lakh 30. On 1 lakh 30, you pay 30% tax, which is 39,000. So 1 lakh 30 minus 39 will give us 91,000. Now, preference dividend. We have 2 lakh 50 of loan, we have 2 lakh 50 of preference. So on 2 lakh 50 of preference, we pay 8%. Again 8% of 2 lakh 50 amounts to 20,000 rupees. So preference dividend is 20,000 rupees. So after paying preference dividend, the amount available to equity shareholders is rupees 71,000. No new equity shares have been issued. You are issuing only preference capital and you are raising through loans. So existing number of shares remains same, 5,000. 71,000 divided by 5 gives us 14.2. If you look at it, our earnings per shares have increased further from 14 to 14.2. And the last option says you raise the entire 5 lakhs only through preference capital. So when you raise the entire 5 lakhs only through preference capital, no interest, because there are no borrowings, no interest. So your EBT will be same 1 lakh 50, on which you pay 30% tax, which is 45,000. So EAT is 1 lakh 5,000. Now preference dividend will be 10% of 5 lakhs. So 10% of 5 lakhs is 50,000 rupees. So what is left for equity shareholders is only 55,000 rupees. So this 55,000 rupees you divide amongst the existing equity shareholders, that is 5,000, you get EPS of rupees 11. So what we find is that the EBIT is the same for all the 4 options, but depending upon your kind or depending upon your source of fund, how you are designing the capital structure, your earnings per share will change. Now let us learn B and D together. There is some significant learning when we compare B and D. In B, we raise full 5 lakhs through debt, and in D, we raise full 5 lakhs through preference. What is interesting here is, on 5 lakhs, you pay 10% debt, and on 5 lakh of preference capital, you pay 10% dividend. So the cost is also same 10%, 10%. The amount is also same 5 lakh, 5 lakh, but the end result is something different. Let us carefully note, when I raise the entire 5 lakhs through debt, I pay interest, and my interest is 50,000 rupees over here. And when I raise the entire 5 lakh through preference capital, I pay 10%, again 50,000, but not as interest, I pay it as preference dividend. तो ये अमाउंट 50 है, वही अमाउंट इधर भी है, but look at the end result, 14 and 11. Why like this? Because we pay interest of 50,000 rupees, EBT is 1 lakh. So we pay tax of only 30% of 1 lakh, tax amounts to only 30,000 rupees. This 50,000 when you pay as preference dividend, the interest is nil. Therefore you end up paying tax on 1 lakh 50. Here we pay tax on 1 lakh, but here we pay tax on 1 lakh 50. So when you pay tax on 1 lakh 50, 30% of 1 lakh 50 is 45,000. Compare B and D, यहाँ पे tax कम है, यहाँ पे tax ज़्यादा है. That's because you're paying interest. This is the advantage when you borrow, and this advantage we don't get when you raise through preference dividend. That is why, although the amount that you pay is 50 over here, 50 over here, but the end result you see, EPS is 14, EPS is 11. So when I compare A, B, C and D, the earnings per share is highest, that is 14.2 in option C. So it makes sense in this or under this given situation, we can conclude that it is best for the company to raise 5 lakh using option C, wherein 2,50,000 company loan ले लेगा या डिवेंचर ले लेगा at 8%, balance 2,50,000 8% प्रेफरेंस कैपिटल के थ्रू लेगा. Thereby, it is able to provide highest possible earnings per share of rupees 14.2. This is one method wherein we consider highest EPS to decide on the capital structure. There are further theories in this chapter which we will learn once we start with our curriculum. So this clipping will definitely give you a brief about what is capital structure, the proportion of own funds, loan funds, how much loans होना चाहिए, how much equity होना चाहिए, and how much preference capital होना चाहिए. So equity, preference and debt, the proportion of each source of fund considering highest EPS is what we looked at in this video clipping. So for all those who are interested to join for financial management as a course, do contact me. My number is available in the page itself. We can, as per your syllabus, proceed ahead for the online coaching program. Thank you very much, everybody. And for those who have liked this video, do share this video, do share this link with your friends, with your contacts, so that this video will be useful for everybody, for those who are learning financial management, for any BCom, for any BMS, BAF, any commerce related students. They will definitely find this video useful. So do spread the word and do spread the link. Thank you very much.